Pramod Gubbi, founder at Marcellus Investment Managers, is joining us on the show this morning. Pramod, a very good morning to you. And, we'd spoken to Saurabh a few weeks ago and gotten a sense of the theme that as a house you're looking at, and that is the essentials and how you're positioning yourself, to probably beat what the market is looking at currently. And you've done that with your fund in this month as well. Is that the focus? Is that going to continue to remain the focus?
Absolutely. I don't think it's just a matter of where we are at the market cycle. That's a philosophy that we like to follow, because one of the tenets of the philosophy is the low volatility. The low volatility, by definition, would mean that we will have to perform at all stages of the market cycle, and that means that you will need companies which can grow their profits irrespective of what's happening in the external macro environment, irrespective of the economy is growing or geopolitical risks, and so on and so forth. So the only way we can position ourselves there is you have a couple of 100 million middle-class Indians who will go on with their lives irrespective of what's happening outside in the outside world, consuming a basket of goods and services day in and day out. That means that the companies catering to that basket will see some sort of a steady demand in a secular way. So that remains the focus. I don't think it's got anything to do with the stage of the market cycle. We will continue to focus on companies which produce essential goods, companies which have very strong competitive positions, almost a quasi-monopolistic position, therefore eliminate any sort of competitive threat risks as well. And at the same time, use our forensic approaches to pick out the best corporate governance companies as well.
This has been the narrative so far, the Indian story, and we've been playing on that demographic. But still, I think the FMCG companies have posted decent set of numbers. We've not seen at least, the leader of the pack, HUL, the growth has been between 6 to 7% when it comes to volume growth. But one key takeaway, even from the commentary of HUL, has been the rural growth, which used to grow at 1.3 times the urban. That's cooled off. It's at par with urban. Does that worry you? Because earnings could grow because these are the essentials which we will continue to buy, but the earnings growth may not be the same which we were factoring in at the start of the year.
No, absolutely. It has been a worry, not just now, for the last 2-3 years now, that rural has underperformed urban in terms of growth. And it's no surprise. It's exactly almost 3 years ago that India took one of the biggest transitions in the form of demonetization. And remember, the rural economy pretty much ran on cash. And if you took the whole currency or the liquidity that drove the economy out of the equation, this is perhaps
that
the
would
biggest.
Probably also be the case with a market which is not just related to rural, because there was a full-blown cash market, another sort of economy that runs parallel to the digital economy that we are in currently. So that totally, the backbone gets broken.
Absolutely, absolutely. The impact is, of course, across the board, more so in rural compared to urban. Urban, I guess, benefited in some ways because there was a wealth effect as the money came back into the financial system, and that financial system absorbed that money through flows into equity mutual funds. We saw 2017 was perhaps the best year for the markets in several years now. So urban demand held up because of certain other effects which did not help rural. And I guess at some stage the adjustment will be complete. Our sense is we are nearing that point, and you should see a pickup in rural as well, provided there are no further shocks.
Yep, and actually, we as a country, we don't come out with, the payroll data, but I think I was just looking at the HUL presentation. They did highlight even the wages have been falling. So, the daily wages who earn money in cash, they were impacted post-demonetization. Probably the tremors of that are still being felt. The other sector, which has been in focus, Pramod, has been the autos. We've got the GST Council meeting now coming up on September 20th. A lot of talk with regard to GST reduction. Not too sure whether that's going to happen or not, considering the revenue shortfall on the GST side. The other side of the market, which is hoping with regard to some bit of, development coming in on the scrappage policy. Are you looking at that front? If that comes about, would that, take care of the auto space ahead of the festive season?
Well, I mean, it doesn't tick the essentiality box in terms of demand. It remains a little bit of discretionary in terms of the nature of the demand. Hence, we are unlikely to look at any of these companies. But yes, I think autos are classic cyclicals. To that extent, a lot of the slowdown is because of cyclical factors.
You're not saying it's a structural...
We beg to differ. We don't think the effect of car ownership or electric vehicles or disruptions have had a material effect. Of course, at the margin, there are factors at play, but by and large, this sort of a slowdown is largely cyclical in nature, and we reckon at some stage, the inventory cleanup will happen, and the auto cycle will bottom out and come back very strongly. And we are a poor country at the end of the day. I don't think we can say that penetration of any of these, whether it's cars or two-wheelers or trucks, are at a level that India doesn't need any of these anymore, right? So our sense is, yes, there's a recovery around the corner, whether it's a question of 2 quarters or 4 quarters. It's
so
hard
ahead
to get
of
the
that,
timing.
Would you start piling them up? I mean, if you had a Maruti at 9, not getting to stock specific, just to get a color of it. If you had a stock at like Maruti at 9,800, it's at about 6,000 right now. It's still lying in your portfolio. Would you look at, starting to make sure that they normalize, average out in a way?
Well, to the extent that timing is perhaps the hardest part of our profession, we wouldn't back ourselves to time it to perfection, to picking it right at the bottom. To the extent that some of these stocks are giving you some sort of margin of safety from an intrinsic value perspective, there's no harm starting to bite into some of these companies.
But would you also agree if Maruti was expensive at 9,000, it is still expensive because with prices coming off, earnings too have come off, it's still trading at about 25, 26 times.
Yes, I mean, that's exactly the point. Because the earnings have come off, you're looking at the multiple on bottoming out or a distressed earnings level. So it's not the right way. Usually you will get a high P multiple at the bottom of the earnings cycle.
Sure.
So it's not a surprise. Our sense is the question is whether the earnings will recover in the next 3 years or so. Our sense is yes, as the auto cycle improves, the earnings recovery should be there for the next, if you take a 3-year view, for any of the auto sectors, particularly passenger cars. And from that perspective, I think the valuation gives you a little margin of safety.
So on month-on-month basis, couple of two-wheelers did register an uptick of just about meager uptick of 1 to 2%. Yesterday, Cogensis, reported that a couple of these companies from the likes of Maruti are offering discount ahead of the festive season. If one were to take a bet now at these levels, we've seen some bit of recovery from the month of August in a couple of these stocks. Where would you advise parking money, be it PVs, CVs or two-wheelers?
I think two-wheelers would be the first place that you would look at, because I think when it comes to the discretionary nature of demand for these products, the two-wheelers are less discretionary than the other two. Passenger cars, of course, are higher up the value chain, both in terms of ticket sizes as well as the aspirational nature of the cars, whereas two-wheelers still deliver some sort of utility value. Commercial vehicles, of course, you will need the industrial cycle to pick up before you can see some sort of strength in that recovery. So I would look to start with two-wheelers amongst that pack.
Okay. Also, let's talk a little bit more about, we've had a lot of announcements from the finance minister trying to spur on-ground growth. Various sectors, obviously, some were accepted well, some not so well. A lot more was anticipated. But all this had to actually translate into numbers.
Yep.
While we did see the IIP numbers grow, inflation's coming off, do you feel that a meaningful change is just around the corner with regards to the numbers really reflecting what all has been announced?
Well, I don't think the government has a magic wand to turn things around overnight.
Sure.
Usually takes some sort of lead time before it starts paying off. But the biggest move has to be around, sentiment booster, what we call as animal spirits. You need people to start spending, both in terms of consumer spending as well as businesses spending on new projects and so on. Part of the issue has been a crisis of confidence, as we know, starting from the lending side of things, be it banks lending to NBFCs and NBFCs lending to certain other borrowers, be it the SME community or the developer community. So we need to get that crisis of confidence broken, get confidence back into the system so that people start spending and investing again. I don't think any of the announcements have led to that turnaround in confidence just yet. Yes, they have been positive at the margin, particularly the rules around FI money coming in. We've already seen a turnaround in that. That happening. Marginally so, but I think it has gone. Speaking to investors, it is quite positive in terms of retracting those those laws that they had implemented earlier in the budget. But for the overall economy to turn around, I think we're perhaps a couple of quarters away. I don't think you'll see immediate effects, at least in the next month or so.
Okay, so let me just get your a very short answer. At Marcellus, the view now is what on Indian equities? Positive, neutral, what?
Well, we've always been, positive on certain companies. India has always been a bottom-up market. I think, irrespective of which stage of the market cycle we've been, India has always presented stocks and companies which could make you money, whether it's the bottom of 2011, 12, 13, or in the last couple of years. We ourselves have seen, our fund is up almost 11% in the last 9 months. So as far as, bottom-up stocks and opportunities are concerned, we continue to remain positive. We continue to see inflows into our fund, and we continue to deploy them instantaneously.
All right, Pramod, we'll leave it at that. Thank you so very much for joining us this morning.
You're welcome.
Really appreciate your time.